Securities offered through Kestra Investment Services, LLC. Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC. Kestra AS, an affiliate of Kestra IS. Capital Advisory Group, Inc. is not affiliated with Kestra IS or Kestra AS. Neither Kestra IS nor Kestra AS provide legal or tax advice and are not certified public accounting firms.
You work hard for your money. For the next hour, you're going to learn how to keep what's yours. Capital Advisory Group presents Keep What's Yours. Here are Josh Gilbert and Jeff Zufall.
Hello and welcome to Keep What's Yours with Jeff Zufall. I'm Josh Gilbert, sitting here with Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. Hello, Jeff.
Hello.
Welcome back to the show.
Thanks for having me.
And well, thanks for having me, because you're the one that really keys us in on all these things that we need to know about our taxes, about our finances. What's the future going to hold for us? We don't know, but we can predict with almost perfect certainty that there will be taxes to pay.
That's almost a guarantee.
Almost a guarantee. Death and taxes, they go hand in hand.
Hand in hand, yes.
The two perfect guarantees in life. But you don't necessarily have to pay all the taxes that you've been paying or that you think you might be owing in the future. There are ways to get around the tax laws, or I guess in a better sense of it would be to utilize tax laws.
Exactly. That's the better way. You're not getting around. You're not
correct. And that's kind of what we do on the show. We draw the line and say, this is why you can, declare your home office, and this is why you can't, which is something that we'll get into in just a second. But there are certain tax laws that are out there that are beneficial to us that we might not be using just simply because we don't know about them.
Exactly.
And the only reason we do get to know about them is because we sit down with a tax professional like Jeff, or we listen to the show here on the weekends. Keep What's Yours, allowing us to keep more of our money in our pockets, on our paychecks, in our 401ks, rather than going out to the federal government in the form of taxes.
Exactly. Legally reduce.
You legally reduce your tax burden, and there was that one guy. You remember his name. He stood up there at the debates and he said, "Why would I pay more taxes than I legally have to?"
Yes.
And say what you will about the politics or whatever about it. I love paying taxes. I'm probably the only American that says I am fine paying taxes.
Love paying taxes?
But I don't want to pay any more than I absolutely have to.
Then you're legally obligated to.
I mean, if he found a tax loophole, then let's close that loophole.
Exactly.
And that's, it's a game. It's a game that gets played, and, it's not really fair to individuals like myself because I don't know the rules.
Exactly.
I haven't read the rule book because it's
the
7
rule book
Bibles.
is pretty boring to read.
It's the tax code.
Yes.
7 Bibles worth of information in this thing, and there's like 3 or 4 pages that might actually
apply to the average individual. Exactly.
So it's just tough for someone like me and for the listeners probably to get a handle on what all we could be taking advantage of. So we need somebody on our side and in our corner, and that's Jeff.
Yes.
He sits down with our tax information, a couple of years of tax returns, paycheck stubs.
Any brokerage statements, and then we can take it and go from there. I mean, in October is financial planning month, which is coming right around the corner.
Oh, that's perfect.
Tomorrow.
Yeah, it's here.
So again, the question is, how many people have a written financial plan? And if you had one created for you in the past, have you ever dusted it off and looked at it and said, "Hey, I'm supposed to be doing this or that"? So that's the process of this tax planning. Tax strategy fall into the financial planning arena. I mean, it all goes hand in hand. Everything that you do in your financial life will end up on a tax return, and vice versa. So at least be aware, prepare for it.
And there are people that are out there that people might go to. I don't know if you call them money people or retirement people, who just kind of focus on the accumulation phase.
Exactly. Yeah.
And they,
they're good at what they do.
Let's make money.
Yeah. But the trick is what is your net effect after taxes as you go forward?
And there's I heard someone say a false sense of security when you look at what's in your 401k or you look what's in your retirement account and you see that big number there.
Yes.
Let's just say it's a 1 with 6 zeros behind it.
Yes, that's perfect.
I would love that. That's the goal. But you're not counting all the taxes
Yes.
that have yet to be paid.
So really of that $1 million account, you technically, depends on what state you live in, but here in Missouri, probably 700 of it might be yours, high 680s. The rest goes to tax. If you cash it out all at one time, that'd be huge. Again, you're going to take it in income stream over time, and that's the game that we play, and this ties into October as Financial Planning Month, is most people, when they sit down with us, will just put a tax plan into place. But what they see is in their late 60s and their early 70s, all of a sudden the tax plan goes crazy because you have Social Security that's paid to you, and then your required minimum distributions show up, and poof, the two create a tax time bomb.
And there's a lot of people out there that say, you know, we did really well. I don't need to take any of this money out if I don't want to, but the federal government has come along with required minimum distributions, and they said, we don't care if you need this money. We
want our taxes.
We as the government need our money because it'll just sit in our accounts waiting to get taxed until we take it out. But if we sat on it till we were 80, 90, then the government isn't getting their tax money.
Exactly.
They'll get it all eventually when we pass away. But they want it today. Yeah. Because there's bills to pay today.
Exactly.
So they kind of tacked that on there, and they gave us this beautiful gift of pre-tax 401k.
Yes.
Yes. And they allow us to utilize it.
Exactly. And the concept, what a lot of people forget, is we either see the extremes, and the extremes are, I'm not going to put money. Younger people are saying, I'm not going to put money in my pre-tax because I know I'm going to pay tax at a later date. And over time, the tax brackets will go up. I agree 100%. And then we see older people, they're like, man, I packed all this money away, all pre-tax, but then they have issues at retirement because everything is taxable that comes out. There is a happy medium somewhere in between there. And the concept is figure out what your expected retirement date is. And if you are literally at a 24% tax bracket today and you pre-tax money, and you know that, hey, when I retire, if you build a plan and look at it, you could say, hey, I'm going to fall into the 12% tax bracket when I retire because I don't need as much money. Still need money, don't get me wrong, and you probably need more than what you think. But the concept would be to pre-tax it at 24. You'd save 24% tax putting the money in. You retire, you're going to take it out. You're going to take it out at a 12% bracket. So you've saved 50% in taxation.
And that is how the game is played.
Yeah.
And if you are putting money away into a pre-tax 401k, you know that you are making a deal with the federal government. I will pay you later.
Yes, that's all it is.
You have to know that later is going to come.
Yes.
What is your plan?
And the concept, what we try to build in plans is, hey, when you retire and you have a lot of money in pre-tax, does it make sense? Does it make mathematical tax sense to do a conversion to a Roth IRA? And in some cases it does. In other cases it makes zero sense to do that. And we've even had people that came in and said, hey, my advisor wants me to start converting to a Roth. Theory sounds perfectly fine, but when you do the math and you do the tax return, it doesn't help.
Yeah.
Because they don't have the time to capture the tax hit that they're taking on that money prior to required minimum distribution age.
And that's one of the best things about Jeff, Capital Advisory Group, CapitalAdvisoryGrp.com if you want to check him out online. Senior tax strategist and wealth advisor. He could be your money guy and your tax guy all at the same visit.
Yes.
And that works out perfectly for us because we're not talking to the money guy and then going back to the tax guy and say, well, the money guy said this.
And we see that a lot too. We see people where they're like, oh, and they start to get into some technical calculations and they're like, oh, consult your tax advisor. Kind of, and then they have to come back to us.
And then Jeff spins around in his chair and says, hi, I'm your tax advisor.
Yeah, but then they come to us, they bring all this data, and then we got to crunch the numbers and get into it. And it's like, why just do it all in one spot and take care of it?
Yeah.
So Yeah.
When you start talking about the taxes, you should get one of those green hats.
Yeah, little see-through green visors. Yeah,
and with the old counting adding machine.
No, I get a lot of people that give me trouble because I won't take the little the adding machines with the paper rolls in it and all that stuff.
Yeah,
I just refuse to do that. I don't. My father did that for a million years. He could look at it. He could be blind and he could still add stuff up and come up with the right numbers. I refuse to do that.
Yeah. Well, the technology's here, but
yeah,
it is I do like those green visors.
Yeah,
they are pretty sharp. And it's just one of those things where you have to make a plan because you've made this agreement with the government to pay them their taxes at a later date, and that date's going to come probably quicker than you realize.
Exactly. Be here faster than you think.
And probably when you're ready to deal with it, chances are, you sit down with somebody and they're going to say, well, you would have been better off if you had thought about this 5 years ago.
Exactly. And the concept would be maybe if you're in your 50s, you back off your pre-tax. I mean, again, it's a mathematical calculation, and math always wins. Maybe you back off your pre-tax and you do the balance in a Roth. And then you kind of roll a couple years out, and that's where that plan comes into place. It'll actually show you exactly what you should do.
Yeah. It's because it's all math. It's all math, and it's never too early to look at the numbers. And you go and see Jeff at tax time on April 15th, but then you also show up in the summer.
Exactly.
And just have a check-in and just always make sure, are we still doing
on track
the right thing?
Yeah.
Do the numbers still work out in our favor? And if they don't, then you switch things up a little bit and you head on and
readjust.
Exactly. So we're going to talk today about taking cash out of your 401k. What are the hits for that? Can you take a loan? What should you take a loan for? What shouldn't you take a loan for? And my big question is, if you go bankrupt, file for bankruptcy, can the government take your 401k? That would be pretty scary, but we'll get into all of that. First, though, I want to mention, because we just brought it up, the home office thing.
Yes.
A lot of people coming to Jeff saying, hey, I work from home in my home office.
Mm-hmm.
Why can't I, deduct, my computer or
they don't say it, but they put it on their what we call an organizer. So when we do tax returns,
they don't say, they just sneak.
We
it in
send
there.
an organizer out, and there is a little section, and it only applies to finite people where you can take those deductions, and then they fill the average person fills it in. Anybody that works from home. And their theory is, hey, I work from home. Why can't I take the home office deduction? And the problem is you can't. They changed the law in 2019. Used to be able to take some miscellaneous deductions and write it off on Schedule A, but that's long gone. Mm-hmm. So the only way that you really can take a home office deduction is if you have a home-based business. So if you created a sole proprietorship, LLC, partnerships, even out to S-corps and corporations, and you run it from your home, then you get a home office deduction. And the home office deduction is basically you take the square footage of your house, total square footage, and then the square footage of your office. So the example would be you have a 1,000 square foot house and you have a 10 by 10 office. That's 100 square feet. That's 10%. Okay? So then you would collect all of your utilities, any maintenance to the house, and you'd write off 10% of all that stuff.
What if I put my home office in my living room, which happens to be the biggest room in the house?
Or some people are like, well, hey, I use the whole basement.
Yeah. Yeah.
You want it reasonable.
Mm-hmm.
Again, some of the guidelines on a tax deduction says it is a normal or a reasonable expense. And to say, hey, I have the entire basement. Now, yes. Let's say you're a manufacturer. And you haven't quite got it out of the garage just yet, and you're still using your basement, and you have stuff stacked sky high for storage, yeah, I mean that's reasonable. But if you're an accountant and you have a 1,000 square foot house and you have a 900 square foot office, no,
yeah,
not going to work.
Yeah.
And again, you're opening the door when you do crazy stuff like that. You're opening the door for the IRS to come and audit you, and when they do. It may be a finite, 2% of Americans get audited currently. But if your number's drawn and you have crazy numbers like that, they're going to disallow it. They're going to throw it out.
Yeah.
I guarantee it. So,
Well, that's one of the things that people keep asking Jeff about, and here I'll give you an example. My wife works from home quite a bit these days, and it's on carpet. So we bought one of those kind of glass, hard mats underneath her chair so she can roll around a little bit. We can't write that off.
No, you cannot.
All right. So everybody's trying to think, well, I work from home, and I had to buy a new chair, and I had to buy one of those glass rolly things.
Now, here's your twist. You have your LLC. She's a member of it. So how much administrative work does she do from your home office?
Well, now we're talking here.
See?
Now we're talking here. So a moral of the story, what you probably think you can write off, you can't. But what you never thought about, you probably can. And
that's the whole concept. So, yes, you couldn't write off the full amount because she does work there, her 40-hour job, she's sitting there. But I'm sure she probably puts a good 10 to 20 hours in just working on the LLC stuff, making sure everything's doing what it's doing.
Yep, we got a little business on the side just to make a little extra money. So we're going to have to start adding up my wife's. I'm going to have to ask her to start submitting
timesheet.
Timesheets, yeah, so we can give it to Jeff, and at the end of the year, maybe
Josh will be absent next week because he's in the hospital.
yeah. And I'll say, you know what, honey, why don't you take a couple vacation days? But that's the point. The things that we think we can deduct, we probably can't. But the things that we've never even heard of, we can. And we can't take these deductions if we don't even know they exist. That's why you get Jeff on your side.
Exactly.
636-394-5524. 636-394-5524. I think we backed right into a beautiful analogy.
Yes.
You know, you show up to the office and you say, here, I want to deduct my rolly thing for my chair. And you're like, no, but you've got an LLC. Here's an even better deduction.
Exactly.
You know, we're going to let you keep $1,000 rather than just try to write off that $60 floor mat.
And again, the theory is if you go online, you'll hear people that say, oh, create an LLC and you could write off everything that you want in your house. Again, at the end of the day, they're not signing your tax return. That's a kind of an issue. Two, you can't do that. And I say you can't do it because it's all over Instagram. It's all over. I mean, I watch that stuff all the time. And some of them I get really mad at for what they say, and others I laugh at them because I'm like, nobody would ever listen to that, but people do.
Yep.
And the problem is just the big picture of it. The IRS says if you don't create a company just to take a deduction. IRS says that you have to have a profit motive for this company. And again, there's an individual who, how do I say it nicely, has maybe about $800 of revenue, but has a plane that they want to write off. It's a hobby. It is not a business. And he's adamant. He's like, well, I have my licenses. I have all this stuff. I get that. I totally get that. But if you have $800 in revenue and you got a $150,000 plane, it's a hobby. It's not a business.
It's not a business.
And if you try to write that off, the IRS, if they ever see that, will eat you alive on that one. So they'll say it's a hobby.
And there are plenty of things out there for you to take advantage of. Just go see Jeff and sit down and, I'm the king of, harebrained ideas, and I talk to my sister. She's really good
Such
at
a
math.
straight.
Yeah, I talk to Jeff. My sister's the one that used to do my taxes until I got married and we had a kid and we, started renting out a beach condo. Then it just got too, much
too
for
crazy.
her to do for free anymore.
Yep.
And she said, why don't you go find somebody to do your taxes? And so I found Jeff. But every time I tell her my ideas, every time I tell Jeff my ideas, they all buckle under the sheer weight of actual math.
Yes.
Because math always wins, and I don't know how to do it.
Yes.
So go to Jeff with the harebrained ideas, but he'll tell you this is what is in the actual law, and this is what you can actually take advantage of.
Exactly. And remember, that's where those guardrails come into play. As long as you stay within the guardrails, you're perfectly fine. Nobody's going to say a word to you. They may reach out every once in a while and question stuff. I get that. That's what they're supposed to do.
We've got documentation to back that up.
You can back it up. They go away quickly. But when you jump over those guardrails and you're off into the weeds, it's a whole nother ball game. And that's what you don't want to do. Because, again, big picture, I say this seriously, COVID, pretty much IRS shut down. I mean, they literally were working from home just like everybody else. And now they're coming back. When they come back online, And I say in a normal world, they're going to come back with a vengeance. And there will be, the audit rates will skyrocket, and they will back up to the tax return that you did 3 years ago and say, how'd you do that? Why'd you do that? And if you don't have documentation and you're crossing your fingers hoping you slip through, you'll probably get caught.
Yep.
And then you're going to pay penalties and interest rolling forward. So,
Yep. So do the right thing, do
Yes.
your taxes, but don't pay any more than you absolutely have to. Keep more of what's yours. That's the name of the show. That's the name of the book that Jeff wrote, and that's the name of the lifestyle we espouse here. Keep more of what's yours. Pay your fair share in taxes, but not a penny more. Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group, 636-394-5524. Call today. Get an appointment on the calendar. Go to the appointment. Bring a couple of paycheck stubs and, the last couple of years of taxes, and Jeff can start eyeballing things and say, there's a couple things we can do here.
yes. Yes.
Just answer a couple questions and find out, there's a little bit more you could be doing tax-wise to keep more of your money. We're going to go to a commercial break, and when we come back, your 401k, what are the penalties to take it out early, and can the government take it when you go bankrupt? We'll find out on Keep What's Yours on the Big 550 KTRS.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back on the show, back to Keep What's Yours. And Jeff, let's just get right into it. Your 401k. Everyone always has so many questions about these things because they're complicated.
They're very complicated animals.
Like when I retire, how can I take it out? When can I start taking it out? When am I going to get dinged? How do I take it out? The biggest question, how do I take it out with the least taxes possible? That's a whole
Nother scenario.
It's a month worth of shows.
Yes, yes.
But the question that I had today coming in here, and we'll get into actually taking it out when you want to take it out or taking it out when you might need to take a loan from it, but can the government take it when you go bankrupt?
Well, it depends on what your bankruptcy is, for starters, and that gets more into a legal scenario. But technically, yes, they could force you to cash that out, pay the tax on it to pay your debt, or in some cases they'd let you sit, depending upon, I guess really the math within your bankruptcy case. So, in some states, it's clear from creditors where they can't touch it. In some states, an IRA, so you'd think a 401ks would be safe. The IRAs are not safe. So the question, I'll say a financial planning / legal scenario, which I'm not an attorney, but in some cases, some people will say roll over your 401k when you retire to an IRA. And then from a claims of creditor standpoint, that IRA could be subject to the claims of creditor where your 401k could not.
Interesting.
Yeah, so it gets into more of a legal twist in the big financial planning picture.
But let's not go bankrupt in the first
Exactly.
place.
Yeah.
But,
try not to, yeah.
I was just thinking, it's like, if you went bankrupt and you lost everything, and could you still say, but I still have my retirement account?
Yeah, but I've seen a couple cases where they were forced out just due to, they basically started from scratch all over. Everything got liquidated, and they had to work their way back up, paid tax on it, and went forward from there. So again, depends upon the situation, and also depends upon the state that you're in too.
And when it comes to, going bankrupt, I don't know anything about it. I don't know how it works, but I know that sometimes some of your debts just kind of go poof. But I heard that student loan debt never goes away, and tax debt. They're
the two. Even a student loan, which this is crazy, if the student passed away, there's cases out there where they went after the parents and said, hey, your son just passed away, but you owe us $50,000
Oh, my gosh.
Oh, yeah. Now the new rule basically states that in the event of the student passing, that the debt is resolved and no one has to write checks for it, which is that should have been day one, but they didn't. But yeah, so student loan debt is still federal obligation, and IRS is a federal obligation. Now they'll work with you. Typically, if you're in bankruptcy and you owe tax, your attorney will go petition the IRS, do what's called an offer in compromise, to say, again, the late night commercials where, I owed $800,000 to the IRS, and I settled for $7. That does not happen.
Yeah.
I mean, maybe in a very rare case, but I don't.
I mean, I see those commercials all the time.
Exactly. It's more like they're going to look at what your situation is, what the tax debt is versus to what you're liquidating, and it might be 50 cents on the dollar, 25. I've seen a 20 cent on the dollar. So just totally depends upon that situation. But typically the debt is not relieved completely. They go, oh, don't worry about it. You don't have to pay us.
Yeah.
That doesn't
happen. But they'll work with you.
They will.
The big bad IRS.
There's a whole division that helps get that situated. They know you're in a jam.
We need our money, but we know you also need to put food on the table.
Yeah, but you have to fill out a probably, I think, things like a 15, 20-page document to the IRS. They want to know every asset, income, the whole shoot and match, and you can't cheat, basically. We've had a individual who refused to say that he had a Harley, would not put it on the sheet. It was his prized possession. At the end of the day, IRS knew that he had this Harley, and their response from the IRS agent was, sell your Harley, turn it to cash, and then we'll talk.
So, do they come over to your house and they go through your closets?
What they do is if they start looking, they'll just...
He's got personal property tax that he has to pay on that Harley.
That's how they picked it up, was personal property tax. So they went to St. Louis County, scrolled through, said, hey, we see the vehicles and the trailers and the trucks that you have on here, but where's that Harley?
Yeah. That's so interesting.
So he refused to put, and each time the IRS rejected it and said it was incomplete. And I kept looking at it going, well, how's that? I mean, if you looked at it, it looked completed. The thing missing was the Harley. I mean, it was like a $60,000 Harley. So the response to the IRS agent, or his response, was, sell it, we'll talk, which means sell it, whatever you get cash for is enough to pay what that tax debt is, and we'll call it even because you'll pay it off.
Jeff, I need you to store this Harley in your garage for a couple of weeks.
Under that circumstance, absolutely never.
Yeah, I'm sweating it out with the IRS. Yeah. But it's not like they came over to the house and looked for it. They found it in tax returns.
That's what their job is, to go hunt it down, look for personal property tax, maybe go to St. Louis County, pull what your property tax receipt or roster looks like, all that good stuff. So,
and one of the things I like to do on the show is to say, we don't have to be scared about paying taxes. Okay, this is it's part of doing business in the greatest country on this earth. So we will pay our taxes, but not a penny more than what you have to.
Legally obligated to.
And you don't try to hide from the government, because they have ways of finding you. They will track you down. Just do it the right way, and sometimes take your medicine.
Yeah.
I always say this when the deadline's coming up for tax, April 15th or whatever it happens to fall on. Don't bury your head in the sand and say, "Oh, I'm going to pretend I don't owe taxes this year because I don't have money to pay them." Set up a payment plan with them, because burying your head in the sand.
Yes.
It would be like the IRS is standing there next to you with your head in the sand and a clock running, going, I mean, we're still going to be here when you come up.
Exactly. Well, most people are like, well, if I just won't do it, and then what takes place is they don't know the tax that I owe. And after COVID, it's probably true, just because you kind of fell off the roster. But what will take place is when you file your return, most people are like, oh, the minute that I file, they're like, oh, don't file that until I figure out how to pay it. It's like, just file it. Used to be in the past, if you had a tax debt of $25,000 or greater, that within old school IRS, within 2 weeks, they file the tax lien on you, period. Boom. The trick today is when they file tax liens, it doesn't go on your credit report. So it's there, but it's not on your credit report. It actually, of the credit reporting agency, there's the consumer reporting side, and they reach out and look for, like any tax debt, any, maybe lawsuits that you have going or anything like that. That's where they'll pick it up on, is the consumer side, not the credit report itself. It used to be blatant on there, no questions asked. You couldn't borrow $5 if your life depended on it when you had that. And in today's environment, they've set it to the side. It's important, but it's not as important as what it was. Mm-hmm. But again, the IRS is not, within 2 weeks, they're not dropping the hammer on you. So even if you filed your return, got everything caught up, figured out what your tax bill is, and started chunking money at them, they'll work with you.
Yep.
So,
and you just brought up a lien. Can they put a lien on your 401k, going back to 401ks?
can't really put it on a 401k, but they can put it on you personally. So there's a couple of things with the IRS that really freak people out. First one's what's called a levy. The levy is where they levy an asset. They go take it. So what they say...
This guy's Harley.
Yeah. Well, typically what a levy is they'll send you some notices, and you'll go through this process, and it'll be intent to levy. And then one day, poof, they just literally reach in your bank account and take your money. So whatever you have in a bank account, they reach in and grab, pull it out, and you're done. So what they'll do is they'll apply that to the tax debt. That gets your attention. That's what's called a levy, but it's a one shot at your bank account, or maybe an asset sitting out there. But typically 401ks, I'll say, are off limits because it depends upon what state you're in, whether or not it could be levied or whether it's exempt. So that's the first step of the process.
That does seem to be the more scary.
Oh, yeah. People freak out
options.
about that. They really freak out. We usually get that frantic, freaking out phone call, but that's after multiple, used to be. Today it's a little...
Is that like garnishing wages?
Same thing.
Yeah.
But it's not a garnishment. It's not saying, hey, you will send us this money. It's we're taking it.
We're going to take it.
And they
It's
literally,
gonna happen.
no notice.
Will they zero out your bank account? I mean, guys
Zero
got
it
to
out.
eat.
Yeah, I don't care. They'll zero. That gets your attention.
Okay.
So that gets your attention, gets you talking to them. And again,
Hey, guys.
yeah, maybe I should
Noticed I
Yeah.
have no money anymore.
Yeah, and so that's the start of it. And then typically, if you don't respond after that, I mean, depending upon what's going on, it's 30 to 60 days after that to drop a lien on you. But again, I don't want to say that's old school IRS, but that's pre-COVID scenarios. The problem is the IRS is backlogged today. You don't see it that frequently like that. I mean, you'll see the notice to levy, but you don't really see anything happen just because they're so backlogged. That's not saying that as this money gets put in play for them and they get back on track, that they don't go back to the old school scenarios. And that's what people are really afraid of the IRS for.
Yeah.
And I don't blame them.
But when you talk about your 401k and maybe the government makes you liquidate part of it to pay off a tax bill or something,
Yes.
what hits do you take? They say, don't take out of your 401k early. You're going to get penalized.
So under 59.5, there's a 10% penalty. So if you took $1,000 out of your 401k,
Because the government wants you to save that money for your
retirement, not
if you take it out early,
to buy a car or house
it's not what they gave it to you for.
Exactly. It's long term. It's to create your retirement income. So if you took $1,000 out,
That's 10%.
10%, $100 just in a penalty alone. And that penalty isn't deducted. That 10% penalty is not deducted from your withdrawal.
And then I have to pay taxes on the 1,000, not on 900.
Exactly.
Wow.
And so
they really found a good way to really get you.
The 10%, though, doesn't show up. So if you go, hey, I'm going to take money out of my 401k and I'm going to withhold 20% federal and 5% state, so that's 25% of your $1,000. So you get $750 in your pocket, $250 is given away to the federal government and the state of Missouri. The problem is that $1,000 shows up on a 1099 at the end of the year. The 10% penalty is imposed on your tax return, not on the withdrawal. So a lot of people forget about it until they do their tax return, and then they're like, whoa, what happened? And that's the 10% penalty coming to life on the tax return itself. So you may have the math calc correctly on the 1099 tax withholding, but you got to add an extra 10% to it when it hits your return.
For you.
Yeah.
But can't people take loans from their 401k?
So you can take
Is there a way to do it responsibly?
There are. I mean, I've seen some situations where it's worth it, and I've seen situations where it's not worth it. But basically, it again depends upon the administrator of your 401k. Some will allow it, some will not. Some, if you want to take a loan, might charge you $50, and that's administrative fee. But typically, it's $50,000 or 50% of your account balance, whichever is less. So if you had $150 in your 401k, you could get $50,000 easy. The trick is it's paid back over 5 years, and the biggest risk that you run is what if you lose your job in the process of that as you go forward, paying it back. Problem is you got to come up with whatever your balance is to pay it back in full, to not pay tax on it, or pay tax on it.
Yeah.
So if you're not expecting a layoff and you just got a, did a $20,000 loan on your 401k, boom, you either have 20 grand floating around someplace that you could pay it back with and it's not taxable, or you eat the tax on the 20 grand.
So what about job switching? You lose your job,
Even
you
if,
don't have any income.
even
from
if
it.
it's not your control, it doesn't matter. If you are terminated service from that employer, which would terminate service with that plan, it's you get 60 days to pay it back, basically, and that's it.
Oh, so I got to pay it back if I jump jobs.
Yeah.
And then I can transfer everything back.
And then once you pay it back, you could transfer everything to your new 401k or transfer it to an IRA, or roll it over to an IRA, whatever you wanted to do.
Is it hard to transfer your 401k when
No.
you move jobs?
Simple.
It is.
Typically a phone call, tell them where you want it to go, that you're aware of the tax consequences if you take possession of it, and poof. The funny part is people really panic, and today there's still some, I'll call them administrators of 401ks, that literally will cut a check. So you roll over $600,000, they will cut a check and mail it to the client.
Really?
And people are like, what? They do it still. It's made out to a separate trustee. Nobody could really cash that.
Mm-hmm.
Even if they did, there'd be a 30-day hold on a $600,000 or $700,000 check. But it's just funny that they'll mail it, and we think nothing of it.
That's like old actually
school.
using dollars.
Yes.
Yeah.
The check it
I
takes
need
like
to transfer my
4 days to show up, and
yeah,
then people are
401k.
like,
They're wheeling money out.
So they got this check, and they're calling. They go, it just showed up in the mail. I'm on my way right now.
That's so weird.
Yeah.
But with companies and everything, what if I move companies and I never switch my 401k?
You could technically leave it there. If it's under $2,500, they're automatically.
I'm not getting a paycheck from them anymore,
No.
so it's not growing.
But remember, the employer is paying a probably per head count of employees, a annual fee to hold you in that position. So some will politely ask you to move it.
Yeah, hey, get out of here.
Because they don't want to pay the cost of it anymore,
Sure.
and or have the liability for it since you're not an employee. But there's no IRS rule or any rule that says you have to roll it over immediately. Typically, if it's in a decent plan, even though you're at a different job, you could leave it there.
Yeah.
If your fees are low and it's making you money, just the fact of it's out of sight, out of mind. A lot of people don't pay attention to it until the markets, implode one day, and then they're like, "Oh yeah, I got that 401k out there. I forgot about it."
Yeah.
And it's too late. So.
All right. So taking a loan out from your 401k, it sounds risky, but have you seen people do it that was probably a good idea that they did that?
Yeah.
And have you seen people do it where, oh my God, you should not have ever done that?
Yeah, buy a car.
That's a bad one.
Or loan other people money from money that you borrow from the 401k.
That's a bad one.
That's a terrible one. But paying medical debt, I've seen that where they got to go get something done, or somebody in the family does borrow it, pay it, and then basically using it to buy a car is, I'll say, borderline terrible, and or tax debt.
Yeah, tax
'Cause
debt
it's-
is okay.
Because it's okay to pay, because it's better to take a loan and owe your 401k and run the risk on that side than it actually is to deal with the IRS and pay them interest and penalties because you haven't paid your tax.
And that you owe them money, but you also owe them interest. You also
Yes.
owe them penalties. So that's a debt that you want to pay off
And remember,
as soon as you can.
I think the rolling tab on a quarter for interest rates with the IRS currently is like 7.15 quarterly.
Ooh.
So it's not in the past, and again, I say this, IRS will smack me, but in the past we were like, hey, it's like 1.2% a quarter. It's not that big of a deal. You could probably make money someplace else, ride it to the last day, then pay the debt. Today, pay the debt. Don't play any games with it. Mathematically, you can't make that in the open market enough to offset the interest that you're going to pay the IRS on that money.
Yeah.
So,
All right, pay your debts. That's kind of the answer here. But especially when it comes to the IRS, they'll find you.
that they will.
You can't hide that motorcycle underneath
No.
those old paint cans.
Nope, they knew right where it was.
They did. They really did. So just things to keep in mind. You can take a loan from your 401k, but consult somebody before you do
Yes,
it. 'Cause
definitely consult somebody just to make sure that you're doing it correctly. because a lot of it is self-help today. And again, the Fidelities and the TDs of the world, there's really nobody to talk to.
Yeah, right.
They'll force you to go online, press the buttons, poof, you're done. Then the bad effect of it is, the other side effect of it is, typically the dollars that you borrow go into like a temporary account. So you're really not getting the advantage of the market if you borrowed all your money out of your 401k.
Yeah.
So,
well, if you need to talk to a professional about it, I got one here for you. His name is Jeff Zufall.
yes.
And we've been talking to him here all show. 636-394-5524. 636-394-5524. Senior tax strategist and wealth advisor with Capital Advisory Group. CapitalAdvisoryGrp.com. We'll go to commercial break, and when we come back, the Masters Rule. What's that all about? That sounds like fun.
Yeah.
Golf in Augusta.
Be real nice.
We'll get into that right after this.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back on the show, and really quickly, before we run out of time today, Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group, 636-394-5524. If you need somebody to walk you through all your 401k questions that we just had, and we probably brought up a ton of questions on the text line. Oh, well, what about this? What if I take my money out for that? Da, 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 da. Talk to a professional, and his name is Jeff, 636-394-5524. You were telling me about the Masters Rule down in Georgia. This is fun.
Yeah, so there is a rule out there, been out there for a long time. It's the Masters Rule. So what it says is you could rent your home to anyone for 14 days and you do not have to pay tax on it.
And this seems really odd that this would come into play when everybody likes to go down to Augusta, Georgia.
Yes.
For the week or two leading up
The
to
Masters.
the Masters.
Yes.
And they rent out these beautiful homes, and people pay them top dollar for it.
Top dollar.
And somebody probably said, hey, we're getting dinged with a lot of taxes.
Somehow they were able to, or maybe some of our beautiful Congress people, our senators,
Live
belong
down there. Yes.
and said, hey, every 2 weeks we rent our house for $50,000. We want to do that without paying tax on it. And they carved off their own rule.
Typical political.
Yes, probably that's how it
handshake.
happened. But in today's environment, you literally can. There's the Augusta rule out there. You could rent your house for 14 days to somebody, and you don't have to pay tax on it. It's a real rule. The problem is the IRS has now caught wind of this, and with the Airbnbs kicking in, I think they said like in Scottsdale, Arizona, I forget what the number was. It was like 35 or 40% of an entire neighborhood was Airbnbs. So an Airbnb could go, wait, I could use that rule, and
14 days?
14 days. I don't have to pay tax on my rent. So the IRS is scrutinizing this, and it is actually under review as we speak. The odds are they're either going to revamp it completely or do away with it totally.
Well, look, it's like these old, southern Georgia muckety-muck. Oh, whoa, rent our houses out and get a nice tax break from the government. Well, you put it in there. And,
exactly.
The rest of us
have
wind
caught
of
on,
it,
and they're using it.
and now we can use it. Let's do it.
So if you lived on a golf course and you rented your house to, for a tournament or some event, house around Norwood Hills when they have the seniors come in, and you rented your house to them, you got 14 days, you don't have to pay tax on it. It's legit. IRS can't say a word to you. But if you live in the middle of suburbia, and you just rented your house for 14 days, you technically, the way the rule states, you don't have to pay tax on it, but it is going to get scrutinized. And maybe even pulled back. But it's a cool rule out there. It's been out there for a while.
It's a fun mixture of political backdoor
Yes.
dealing, self-dealing between rich people and politicians, and the rest of us starting to catch on and trying to use it for ourselves.
And in some of the cases in Augusta, I think seriously, some of the houses that are surrounding the club itself, the golfers themselves, they literally, the owners of the house have their houses emptied. Literally, they have a moving company come in there like they were moving out. They move everything out. They stage it with some furniture, and then the professional golfers come in and bring their own entourage, and that's where they stay for like a week or 2 weeks.
I mean, they can make $50,000,
Exactly.
$100,000 doing this. And
Exactly.
How much would you have to pay tax on that? That would be regular income, right?
Be regular rental income. You'd have to do it on Schedule E. You'd have no expenses. It'd be all taxable to you. So depending upon what your tax bracket is,
So these
be
people were
huge.
saving 30-something%.
Sure, easy.
Easy, just with this rule. The new rule, Jeff, is going to be only gentlemen, Southern gentlemen with mustaches.
Yes.
And big white hats.
Have to be in a certain zip code in, Augusta, Georgia, or something of that
we
effect.
need to narrow it down so
or
that everybody...
around golf clubs or something of that effect. So, yeah.
Well, and we'll see if that one can actually get passed.
Yeah, we'll see.
Maybe the feds will be like, "This, you guys made this too specific this time."
Yeah. So, but it's very vague, but it's out there. So literally, take it and run with it.
All right, that was a fun one, Jeff Zufall. This show was a fun one. Thank you so much.
Thank you.
Talking 401ks and even in the first segment, that home office. If you've got a home office and you work from home, but you work for a company and you're not self-employed, it's going to be tougher to take those deductions.
Unless they adjust the rule. And again, you got to realize all of Trump's tax cuts sunset in 2025. So whoever wins 24, their hands played automatically that they have to adjust tax law. Not that they want to, they have to the way that it was designed.
But hey,
so there'll be a ton of tax law changes in 2025.
But in the meantime, we know the guardrails, and we just have to stay within inside of them and try to keep as much money in our pockets, in our savings accounts, in our 401ks, in our hands, rather than going out to the federal government. And Jeff can help you do that. 636-394-5524. And the biggest takeaway for me for this show this week, Jeff, was that you go into Jeff's office thinking that you've got a bunch of deductions in hand, and he'll tell you those are bogus.
Yeah, we can't take those.
But what you never even thought about is something that you could probably take advantage of, because we don't read the tax code. I don't know what's actually in it.
Yeah.
But Jeff does. And he says, throw those receipts away. We'll actually get you set up with something that can actually help you out and keep more of your money, and you walk away happy. 636-394-5524, CapitalAdvisoryGrp.com. Jeff Zufall, thank you so much.
Thank you.
We'll see you next week.
You betcha.
You've been listening to Keep What's Yours with Josh Gilbert and Jeff Zufall, Senior Tax Strategist and Wealth Manager at Capital Advisory Group. To learn more, call 636-394-5524 or visit CapitalAdvisoryGrp.com.